Okay, great. I think we can start already. People will join us in the next couple of minutes. First of all, I really have to apologize. I'm co-organizing a conference, and then I missed the first day. And the problem is my son was tested positive on Tuesday, and with small kids, then they close childcare, and someone needs to take care of the kids. So this is what I did yesterday and on Wednesday. So I apologizes for that, but there was just no way around. And of course, it's impossible to find a babysitter for a child that is corona positive. But the good thing is all are healthy, of course, no symptoms. So I'm happy to be here with you, at least for the second day. And I'm even more delighted to have our speakers with us. The goal of the last session here is also to combine discussions you had yesterday and this morning, and really to focus on what it means to do tax reporting in practice. And by tax reporting, we of course mean tax reporting in relation to sustainability. And that's the goal of the last session. And we have two speakers as kind of representatives of the multinationals, so who are responsible for doing the tax reporting. And then in the afternoon, we have Eelco van der Enden from PwC, who was also involved in drafting the GRI standard, and myself, who might give also an academic perspective on tax reporting and sustainability. So having said that, I think we can start already. As we did in the previous sessions, please raise your hand after the presentation or during the presentation, or write your question in the chat, and I'll try to moderate after the speakers have finished their presentation. Great, thank you. We have Alessandro with us. Alessandro Bucchieri, he's the head Global Tax Affairs of Enel, and he will give us some insights on how they approach the topic of sustainability. Thank you, Alessandro.
Thanks, Peter. Trying to see if I can share my presentation. I hope you can see it.
Yes, perfect.
Okay. Well, first of all, thanks a lot for the nice introduction. And I will spend the next 20 minutes, more or less, in trying to describe what was our journey in terms of tax transparency reporting, and what are the questions, still open questions, that we have, and which I like to discuss also with you if you have any suggestion. We have more questions than answers. So basically, 2 words on Enel. Enel is, let's say, a utility. Now, of course, we are in the business of generating, distributing, and selling electricity to final customers. We are now, I think, by market cap, the biggest European utility, and I think it's second or third worldwide. You will maybe appreciate this because I will show some numbers later on. About our journey. So in the last 5 years, there has been really an acceleration about tax transparency and our approach in terms of public numbers about taxes in general. We started basically the first big milestone was in 2017 with the approval of by the shareholders, the board of directors of this tax strategy, and it was done basically in at the same time when we decided to enter in the covertly compliance regime in Italy. So it was for us a great opportunity to involve the board of directors more on tax matters and define with the board the strategy and also the tax risk, tax compliant risk model. So we published the strategy in 2018, and starting from that, we decided in 2019 to start reporting within the sustainability report about first tax strategy, our tax control framework, and starting to share total tax contribution country by country for at the beginning the 9 biggest countries of the group, which were representing more or less 85–90% of the business. Then we extended in our report of 19 during, of course, published in 2020 to 16 biggest countries, which are covering now 97–98% of the business. And so we started to comply in advance with the GRI 207, at least the qualitative description of our tax approach already in 19. And then we did at the end the final decision of embrace totally the GRI standard, also giving country by country details for all subsidiaries starting from this year. Now, next steps are to try to identify, let's say, new metrics or something which is more extensive with respect to the GRI approach. I will try to discuss it later. So one important point about sustainability and tax is that we found that internal interest from our sustainability colleagues, which of course gathering the external interest in tax transparency. And this year, for the first time, taxes are getting, let's say, a bigger space and into the sustainability report. And specifically, it was identified one of the trend topics, as we define it, for the sustainability report in 2020. So, just to this is just to say. This is becoming really a focus point within the company. So I try to summarize here, and I think it was part of the discussion before that when we approach this, it was and is still quite confusing for a company trying to understand what is important and what kind of information to share. So, of course, main actors in the ESG environment are, of course, raters, developers for indexes, and of course, credit agencies. Now we saw it before, and there are really a lot of metrics and different way of rating a company for sustainability, but specifically in the tax field, it is for at least from me very quite confusing and trying to identify a kind of standard to follow. But in any case, why it is important for us? Well, it is important because, of course, we think that giving transparency to our tax approach is important to attract and retain investors. I will spend some additional word later. Of course, there is an impact on our reputation. And for us, even if it's not easy to measure, also this reputational effect might be also might have an impact on a market value and branding, especially in a company which has put, of course, sustainability at the center of the strategy. What we start to experience is that being sustainable in a broader sense, and also in the tax, is bringing better economic conditions, especially, well, I will make an example for the finance and the issues of bonds. And of course, this is having a really positive impact with the relation of tax authorities. Being able to, let's say, disclose and when we talk with them and demonstrate that we are, let's say, transparent, and we even publish all the numbers, it's really helping in the relationship with Italian tax authorities, but also abroad. So I will not spend much time on this concept in the sense that everybody is taking a different view and is analyzing different things when we talk about transparency. Someone is looking for a kind of tax gap assessment. Someone is just looking at what country disclosures for taxes. Someone is looking at tax policy, in general governance, so the board oversight, the audit committee oversight. So many different point of view and many different needs seems by different, for example, ESG rating agencies. So what we decided to do, I don't know if it's the best option, but we found it out in this, let's say, in this environment, trying to, let's say, be the more transparent, use an approach which is the more transparent, the most possible transparent, giving the most possible transparency. So this year we are trying to follow GRI 207 123 and GRI 207 4. So we are giving disclosures about organization, how to manage tax. And from this year, we are reporting financial, economic, and tax-related information for each jurisdictions in which we operate. So full compliance with GRI 207. Then we tried also to integrate also the view which was somehow described, identified by WEF, the World Economic Forum, trying to give not just a view on corporate income tax, but in general to all taxes that we pay, giving details about both tax borne and tax collected. So we used the, let's say, expanded version of WEF approach. And so combining everything, we decided to issue this integrated tax transparency report, which I think I will extract some slides from the report that you can, of course, you can find on our website. Just to give you a flavor of complexity, we have more than 1,000 entities which are paying taxes worldwide. We have 84 billion euros revenues, 80 billion tangible assets, and our profit before tax was 5 billion this year. And so, in terms of tax borne worldwide, not just including corporate income tax, but also property taxes, excises, and other taxes borne, we were paying 4.2 billion euros. And the figure of tax collected, mainly, of course, VAT, but also other withholding taxes, it's in the range of 12 billion euros. The breakdown, of course, our business is concentrated in Europe, North America, and Latin America. So basically, we have details by country for those areas and less details for the other countries. Those are, let's say, here I'm putting the some metrics that we decided to show. Those are, of course, at group level, but we decided also to have the same level of information in each country. I will show it later. So we were showing basically what are the total tax contribution trends, and we were trying to explain why, for example, from 2019 to 2020, the total tax contribution was slowing down. Basically, in our case, the biggest part of the decrease was VAT collected due to the, let's say, revenues decrease following the COVID-19. And we thought that it was important to, let's say, comment trends and explaining the main economic reasons behind the numbers. We also we were showing total tax contribution turnover to turnover, which measure basically how much taxes do we pay and collect for every euro in revenues generated, which is a quite interesting for me figures. And we were trying also to compare with other multinational, European multinational. Specifically, we were using to compare and to benchmark ourselves with the ABTF report. The ABTF is a European Business Tax Forum, which was issuing a report asking to the first 100 European companies by market cap to give information about their contribution in terms of taxes. So we were somehow benchmarking with this worldwide report. And also we are showing the total tax contribution rate, which is, let's say, the amount of tax borne compared with the profit before tax, before all those taxes, and trying to show trends and explaining let's say, trends again. Then, of course, we didn't forget that the majority of interest for the multinationals is, of course, taxes paid, but specifically the corporate income tax paid. So what we decided, it was quite complex to show all the indicators about corporate income tax. In particular, we were showing the current income tax rate, the effective tax rate measured under the accounting standards, and also the cash tax rate, and trying to compare all these metrics, which, as you see, leads to many some big differences. Trying to explain why those indexes, those metrics are different, how they are calculated, and how you can interpret them. Not being able to choose one of them, our approach was let's try to be open 100% and explain each metric and the trend for each metric, and this is done again country by country. Those are the aggregated numbers, but you can find it by country. Now, I just put a couple of examples. This is the example at the country level. What kind of information we show? Of course, we show the business and the business in which we are operating at country level, the entities involved, revenues, tangible, basically all the information asked by GRI 47. So profit income tax, the number of employees, the average wage for employee, taxes for each employee that of course we collect, and also the breakdown for profit, property, employment taxes, tax on production and services, environmental taxes borne and collected. Oops. And of course, again, we think that if you go with the numbers country by country, if you want to, let's say, give some real information, you don't have just to show numbers country by country, but it's probably worth commenting the trends, commenting why the rates are so different with respect to the nominal tax rate in each country. And I have to say that this is a quite complex effort, also because you have to try to be understood also from non-technical tax experts. Then going to connection, a correlation between taxes, sustainability, and value. Here is a kind of model or a kind of reasoning behind in general, the sustainability, the approach to sustainability of the group. And to make it simple, from a general standpoint, we think that sustainability is really creating value. And to make it short, basically, a sustainable company from our standpoint, especially in our industry, is a less risky company. And of course, if you reduce the risk, your value should be appreciated by the market, which is, by the way, what is happening to our company in the last 4 or 5 years. This was quite, let's say, simple to measure. Let's say we tried also to link our sustainability behaviors to sustainment, to SDGs. And when we talk about environment, this is pretty easy, at least for us, no? Because we can measure the reduction on CO2 emissions, for example, which is quite important for us. And so we were trying also to apply this methodology to the tax environment, and so we were trying to understand if there was a specific link between sustainable tax behavior and sustainable development goals and SDGs. In general, and this is also this is extracted from GRI standard. There is a general link between tax and some of SDG goals, which is, of course, SDG 1, 10, 17, but maybe we can find it someone more. But then what is really difficult, and we are really struggling to understand how to do it, is to link specifically our contribution to the governments in each country and have, let's say, a measure in how much this contribution is really helping in reaching specifically in each country those sustainable development goals, which is as a general concept is there, but then it's very difficult to measure. What is the stage now? We are trying to, let's say, approach from a different angle, since it's very difficult to, let's say, link sustainable development goals with a tax approach. What we are trying to develop is a different view, which is well, basically, let's try to report and let's try to see if we can somehow apply the general concept of stakeholder capitalism and present ourselves also in terms of planning, not just for actual results, but also in terms of industrial plan. What are how we are contributing to the in terms of value generated for our stakeholders and not just for shareholders. And so this is let's say a first attempt to say in any case we are contributing to we are contributing with the, for example, with the tax paid, with the tax collected, but also with the tax borne to the one of our major stakeholder, which is the government. Then, of course, we are contributing to another important stakeholder for us, which are the employees with paying wages and salary in the range of 3 billion. We are contributing also to a big stakeholder, which are, let's say, the banks which are financing us, paying around 2 billion euros in terms of interest. And also we are contributing, generating value for our shareholders, leaving them the income after taxes. So we are trying to see if through this way we can link our tax behavior and our tax contribution to the, let's say, general concept of stakeholder capitalism. This is, of course, looking in trends for the future and also present the company as a whole this way. So I think more or less I was in the 20 minutes that and just giving space for comments, suggestions, and to the audience.
Many thanks, Alessandro, for this very interesting presentation. And I have a lot of questions already, but I think I start with Becky, who her question is in the chat actually, and she writes that how did you collect this data? Did you do it in-house, external advisors? Was it gathered using manually local teams or with some technology?
Well, this is yes, this is a key practical question. We started collecting in 2018. We started collecting it manually, in the sense that usually in the systems of the company, it's not so easy to find out cash payments. Cash tax payments. Now you easily find the current taxes or the P&L part of the tax amounts, but it's very difficult to collect immediately from the accounting system and the cash paid. So we did it at the beginning manually, so asking tax managers in the main countries to give us the data. But now, of course, we are digitalizing all the process. And now, after 5 years, I have to say that we can collect cash payments with this level of detail on a monthly basis. So we have in the dashboard for the tax, now we have cash payments. Breakdown by different type of tax and by country, basically on a monthly basis. And this is also helping, started with the angle of tax transparency, as now is becoming also a tool for managerial purposes, because CFO is starting to look at the numbers in a different way, looking at cash in detail for country, and this is interesting.
Thank you. Other questions from the audience? You can raise your hand or write it in the chat. Alice Jones has a question in the chat. Hi, you said that tax transparency is important for attracting and retaining investors. Have you noticed interest going up since you started publishing tax figures? Are there any figures on this?
Well, the main indicators, it's not quantitative, it's qualitative. It's the number of questions that our investor relator department started to receive from investors after we started to publish this. I have to say that the interest, it's let's say, increasing. When we started in 2018, we didn't receive much questions or much interest, but this is growing. For example, this year we received a lot of different questions also from investors. The other indicator about the interest is, I'm not sure that it's from investors or not, but of course we monitor the views that the tax transparency reports receive on the website, and this is let's say much increasing by 2-3 times with respect to the beginning.
Okay, Yelma, please.
Yes, thank you so much for this presentation. It's very interesting. It gives a global view of what is needed in terms of reporting and how sustainability is so difficult to show and to measure. And one of the questions that I have, because yesterday we discussed about developing countries and why sometimes there are different roads. And one is the developed countries and another one developing countries. And my question to you is, since you are global, do you have any talks, contact with the governments of the countries, especially developing countries, to see how to measure the SDGs, what they needed? How is that dialogue? Does it take place?
Well, I have to say that giving our footprint business, we are, let's say, our percentage of business in developing countries is pretty small at the moment. So we are having some, let's say, development of renewable energy in Africa, in North Africa. But to my knowledge, there is no yet this let's say, direct link and direct discussion. I have to say this is a very small part of our business, but to my knowledge, there is no let's say, an open discussion on this yet.
Okay, Lambos, please. Sorry, your name.
No problem, Peter. Thank you very much. You can call me Harry. Easier, much easier. No, so Alessandro, very insightful presentation. Thank you. I really appreciate for all the details you provided to us today. In my role as leading the tax transparency in Switzerland for PwC, I have a lot of discussions with various of my clients, and a key question that comes most of the times, if not all the times, is what is the cost and benefit analysis, or when they perform a cost and benefit analysis with regard to tax transparency report, they come up with more tangible on the cost side and more intangible on the benefit side. So, and I would like to ask you, because the report that you are producing is very comprehensive, and as I said, very insightful, where you are in this spectrum. I mean, have you done a cost and benefit analysis? Have you been challenged internally or externally? Why you did that, and what is the tangible or intangible benefit that overcome the cost of doing that? Thank you.
Yeah, thank you, Javi. May I just take up also a question in the chat, because it goes into the similar direction. Inelise asks, I believe it is influenced by the story that you want to tell to external stakeholders, but what value have you experienced with internal stakeholders? Has it made your role as a tax function easier? So I think it interacts a bit with Javi's question. So maybe you can take that into account as well.
Yeah. Well, as you said, Harry, that there are no, let's say, clear mathematical cost-benefit analysis. What I have to say that most of the time, the cost of building this, it's overestimated. I mean, if you make, let's say, a small investment in methodology, which is really, especially for, let's say, big companies. I understand that, of course, we are a big multinational with nice revenues and profit, so it's really quite negligible, the cost that we spend at the beginning to with consultants to, let's say, build a methodology. But then if you make some small interventions on the systems that you already have in collecting data and information, I mean, the cost is really overestimated for me when you start thinking this. It's not so to me the investments it's really small. Then the benefit might be intangible, but I can assure you that it's not that a big investment as you might thought before, as we think before. Second, good question. I have to say that the most interesting part was really the interest, the internal interest at the beginning. So when we started collecting these numbers and when we started showing these numbers first to CFO and then to the board of directors, it really we really make a big step in discussion about tax matters with the board, because they really started to understand better where we were paying taxes, how much we were paying, why we were having different, let's say, tax rate in different countries, and they started making questions. They started making, they started being interested in what we were doing, and it was really very, very helpful because it gave us the opportunity to explain what was our tax approach, our tax strategy. So it was really a big surprise for me how those data, those information help internally the discussion with the board. And secondly, very appreciated this kind of view. So the contribution, the total tax contribution view was appreciated by the country managers. Because most of the time they have, of course, discussion with governments in the countries in which we operate, and having, let's say, a report simple with all the contribution that you make in a certain country, you can demonstrate that you are really a good citizen there, and it helps the discussion also with government. So. CEO and country managers were very, let's say, interested in those numbers, and they were pushing us to give them, let's say, timely and with more information. They were using it a lot.
Thank you, Frederick, please.
Yeah, thanks for your interesting presentation. So 2 questions that go in the same direction. That I would have. One is that often it comes up that this could be an issue of that this data could be used by competitors and that therefore companies are reluctant to release it. Was it an issue that was discussed in your case, and what were the considerations in the end? And the second question is that you may be a representative company or maybe not. Do you what do you think? Would the decision have been the same if the tax figures hadn't looked as they looked? Like you said, you pay more than the average rate usually in most countries. That's maybe not the case for all companies, for often legitimate reasons, but sometimes maybe not. And yeah, was this also an issue in the discussions?
Okay, I will start from the second one. Of course, it's very difficult when we started looking at numbers and in general, looking at our approach, historical approach, we had nothing to hide. So we decided that whatever was the result, which was, by the way, let's say, nice to present, but we had nothing to hide. We could explain everything, and for us it is really better in some cases now to tell, say, without leaving the regulator to say what we have to show, and for example, publish the country by country. We prefer to start building a storytelling, so presenting our company and giving our view of the numbers and presenting the numbers. I have to say that in some countries, because we are presenting, as I said, country by country, in some countries there are years in which you are well below the nominal tax rate, just because you had, let's say, recover of tax losses from previous years, because you get an incentive after 5 years that you are asking for, so you receive it in 1 year. But then you can explain it. So if you build an history of 2-3 years, then you can present it, and you can, let's say, explain also in the cases in which you are well below the nominal tax rate. And this is for us, let's say, a good way also to be prepared for in receiving questions from certain countries, for example, in a year in which you didn't pay taxes, or you pay a very small amount of taxes, because you have there the answer, you have the history. Then I think for the first question about the sensitivity of the information given, I think it depends by industry. The different industry might have different issues. For us, it was not really an issue because the majority of information that we were showing, they are already public. There is no much secrets in the margins that we are making in each countries, but probably it depends from an industry perspective. I admit that for us maybe it was easier. We didn't find any, let's say, specific concern about information given.
Thank you. I'm looking at the chat first, Inlis, and then Javi again. She asks, and partly you have answered it already, did you use an advanced automated solution to collect your data and to dashboard the data to the board, tax function, and country manager? Could you maybe be more specific? You mentioned that it's not as expensive as one would guess at first instance. How did you collect the data? Did you use such tools?
Yeah, of course, since the tax systems are different in different countries, of course, you have to look at specific situations. I give you an example. Now, for example, in Italy, which is of course the one of the biggest contributor, we didn't have the information about cash paid for each different tax, but we found it out that in the payment system there was labeling, identifying when we make payments, of course, to the tax authorities, the different taxes are labeled in a different way. And so with let's say with a simple maintenance on the software, we were able, let's say, to collect the data using this information. And we did the same in different countries. So you have sometimes to go into the systems and with IT people try to find different solutions, but it's at least in our case, it was not that complex. But if you want really to be sustainable in giving those informations, and you have to go into the systems and trying to let's say digitize the process. Yeah, definitely.
Abby, please.
Thank you. So, Alessandro, you referred to the storytelling before, and I think that's a very important part of it. If we look at the CBCR as submitted to the tax authorities, someone may argue that the storytelling is part of the table 3, where you have to add some information there. So, however, the user of this information are the tax authorities, the tax administrations. And as we know, tax is a very, or can be a very complex area. So these people are experts, they can understand it, hopefully most of the times. And then that's the storytelling about that specific country by country reporting submitted to the tax authorities. When we move to the public CBCR, the users, the readers of this information are not necessarily tax professionals. So, and I really enjoy the fact when I saw in your tax transparency report that you have also this educational dimension. So how you define cash tax rate, how you define effective tax rate, etc. So the question, the storytelling for the public CBCR differs or not from the CBCR table 3? And if yes, how do you consider of providing the storytelling for the users that are not tax experts?
Mm-hmm. Well, numbers are numbers, and so the story you can tell, it's it's not much different, no? The way you can present things, because numbers are numbers. But apart from jokes, yes, the storytelling is different because, as you said, when you have to publish numbers and go public. Then we try to spend a lot of a big part of the report. The report is now in the range of 100 pages, and we spend a big part at the beginning in trying to make definition and explain, let's say, complex concept about deferred taxes, current taxes, tax loss carry forward in a simple way. I don't know if we succeeded, but the attempt was like to make it simple and explain to a colleague which is not a tax expert. If he can understand, probably the majority of readers can understand it. Of course, the details and the discussion that you have with the tax authorities, it's much more on a technical field. What I have to say, and this is my personal experience, when we didn't have much discussion about CBC country by country data that we have been providing for years to the tax authorities, nobody came to us and asked questions. Even if I'm really surprised because we were just providing tables with some explanation, very short one. And nobody came back to us from the tax authorities. I don't know. I don't have a clue what how they are using actually all these informations. I receive instead some comments and questions about the data that I publish, but not from tax authorities, which is strange, by the way.
Thank you. So if you allow, I will ask a last question and then we move on to the next presentation. Interestingly enough, also when I looked at the presentation, the other presentations this morning, I mean, we are really talking about numbers, and the reports, you know, that seem to be useful are the number crunching reports. So the traditional financial reporting, and spoiler alert, I'm very critical with respect to non-financial reporting as it is currently outlined also in the GRI. What is your view on non-financial information? Because, for instance, you did not present your tax strategy in detail, your tax governance strategy in detail. Would you agree that basically a reader of your non-financial reporting does not get really a flavor of what is at stake. And this is also why now in your presentation you focused on numbers.
Well, no, of course, in the tax transparency report, we spend, let's say, a big part also in describing in details also non-financial information about our approach to taxes, the governance, the tax risk monitoring, and so on. Of course, as I said, the transparency report, it's 100 pages, and then you will find there pretty detailed description of strategy, component by component, how do we approach it, and so on. Of course, I was focusing in this presentation more on numbers, because this is, I mean, the hottest topic. I really, it is also where we are struggling to find a precise way to communicate, because it's pretty easy to communicate what is your strategy, what is your approach from a qualitative standpoint. It's much more difficult when you have to translate into numbers and give a sense to those numbers. So that's why I was focusing on that. But I assure you that also non-financial information are pretty, let's say, extensively touched in the report.
Okay, great. Many thanks for all these insights. I mean, this has been very interesting, and I think the many questions also showed that you know, people really are very interested in what you have to say. So I would suggest we now move on to the next presentation, to Ilan Rom, who represents Swiss Re, and we chose two different companies in two different industries, because it will also show how the companies move in the current regulatory jungle, and depending on you know, what your particularities are, you might choose a different path. I think the path of Swiss Re is to a certain extent quite different than the path of Enel, and I'm very happy to hear from Ilan with some more details on what they do on tax reporting and sustainability. Yeah, let's start. Thank you, Ilan, for being with us today.
Perfect. Let's do a quick check. Can you see this? Can you see the slides, and can you hear me? Okay.
Yes, perfect, and we can hear you also. Thank you.
Good. So thanks for the invitation. I hope you still have a bit of energy left, because there is clearly a bit of overlap between what Alessandro presented and what the content is. We try to minimize that overlap, but let's see where the journey goes. So quickly to myself, my name is Ilan Rom. I'm leading the group head office tax of Swiss Re, which also has a regional responsibility, but also looks after some of the group projects like the sustainability tax topic. So what do I want to present today? I have, you know, for those who don't know who Swiss Re is, I have 2 slides on who we are. I think then I stole some slides from our sustainability group that explains the approach of Swiss Re to sustainability. I want then to establish, just from a practical point of view, the link between tax transparency and sustainability. And then, of course, I want to also, similar what Alessandro did, give you, explain the journey, the tax transparency journey. Our first report was published for 2018. Also show you the report and how it developed over time, and then I would like to close with an outlook. I think it will take me about 30 minutes or so, and so there should be sufficient time for a Q&A session at the end, and otherwise we just go for early lunch. Maybe some preliminary comments. At the end of the panel, I said it shouldn't be an academic discussion because it has real impact. We do tax transparency reporting already. I probably have to balance that out a bit because and that's probably really I hope Sebastian is still on. That's a comment to DJSI, S&P, and the other ESG surveys. I think we can't ignore the academia and what is being asked in the survey, because those surveys have become so important as a topic that it is important what kind of information is being asked, because every question, every additional question, every scope increase has real impact. And I heard Alessandro's comment on the costs. I think there are costs, real costs, in increased public transparency, even if it's just a lot of internal resources that we have to put on these kind of projects. And mainly something, and that is really just a specific comment on DJSI. I think there was quite a significant increase of the scope of the questions, but the overall weighting remained the same. So I think that is also something one could argue that, if you really ask for more information, you should also look at the overall weighting of what taxes takes in the sustainability survey. So Swiss Re, who we are. Swiss Re comprises of 3 business unit divisions: reinsurance, corporate solution, iptiQ. Reinsurance is probably the business unit that we're most famous for. We are insuring insurances. Corporate solution part is B2, is our B2B service provider. We do also insure selected non-insured clients. And then iptiQ is our digitalization strategy, where we are offering white labeling solutions to consumers. So that's a B2B to C service. I think what I want to strengthen, and I think that is maybe a bit that element that we haven't really touched on too much. There was a question on it, but still, I think what is the foundation of Swiss Re? And the foundation really is, it's the people. And I think what is a very important element of the whole sustainability and tax transparency discussion is our own employee and how they react to being more transparent when it also comes to tax matters. Maybe two facts on that. There is a PwC study that clearly says that the majority of the millennials, for those who don't know who they are, that the year of birth 1980 to 2000, would consider leaving an employer if not sustainable or ethical corporate citizen. And I do think that is an important item that also needs to be reflected. I think a lot of the discussions we had with the financial analysts was how the investor would react to it. I think there are also other stakeholders that need to be considered. And then just a practical example that we have, of course, when we publish our tax transparency report, we do, as a proper tax function, we do a bit of self-marketing, of course. We had an article then on the global internal intranet site, and we got quite a bit of feedback. So we really had people coming to us and showing a sense of pride of what we do, how transparent we are, and also how much taxes we really pay in the different jurisdiction. So that is a slide just showing that we are a truly global company, and we have about 40 billion of overall premium that we generate in a lot of different regions. I think one important point here is our vision, and I think that vision creates the basis for why sustainability and sustainability strategy is so important for Swiss Re. We want to make the world more resilient. That's the vision, and I think that also then bridges the link to taxes at the end of the day, which I would like to show also in that slide. Again, a slide that I stole from our sustainability guys, but I think what it really shows that I believe sustainability, especially when you're in the reinsurance industry or also in the insurance industry, I think DNA, it's in the DNA. The sustainability topic is in the DNA of definitely Swiss Re. I do think we're a bit an outlier here because there is, I can't give you the academic research to it, but I would say there is strong evidence for the hypothesis that if we have huge losses from pandemics, from nat cat events, if those nat cat events happen in states that have enough money, then the losses would be lower than in other countries or in other states where there is not enough tax money to work on rebuilding the infrastructure and so on. For example, one of the largest losses we had from the pandemic was business interruption, and I think that also applies to nat cat event. Business interruption is a big exposure that we have, and of course, and a lot of it is not insured, so you need the state to really rebuild the infrastructure in a lot of cases. So I do think that's why, for me, that's part of the societal resilience, that taxes and making sure that the state has enough funding is relevant, specifically relevant for the insurance industry. And then something that is also where I believe we're a bit of an outlier. We have since 2020 we have we qualitatively assess how we perform against our sustainability goals, and since 2021 we also have a quantitative measure. I think that just takes how serious we take sustainability as a topic that has been endorsed by the GEC, it has been endorsed by the board of directors, but also the group EC members have clear sustainability targets, which I can already feel makes an impact, because clearly when we come with our proposal on tax transparency and increased tax transparency, it's easier to get a slot on the GEC agenda when we want to propose what we want to change. And by the way, that's also a reason why I'm here. So we do have, as group tax, we have given our self a goal that we want to publicly engage in tax transparency discussions. So there is clearly, that makes it very tangible that the sustainability topic is important to Swiss Re. On this slide, I would really like to try to make the link between what tax transparency is and how that links to sustainability, to the sustainability agenda. So I think I gave you a definition what public tax transparency means, and I think the important point, I'm going to read it quickly, but so presenting information on economic contribution a taxpayer makes by paying and collecting taxes, and putting this information in the right context to actively build trust and reduce the risk of potential misinterpretation. What are the key elements here? I think, and that is something that also the OECD misses out on a lot, that it is not only about corporate income taxes. Actually, when you look at our report, and I'm sure also what the Enel report shows, corporate income tax is an important component of the total contribution that an M&E makes, but it clearly is only one of many. So what did we do in our tax transparency report? We do apply the methodology of total taxes borne and total taxes collected, which make sure that we not only report corporate income taxes, but that we also show other taxes like capital taxes in Switzerland, stamp taxes, non-recoverable VAT, and so on, with the aim that also an uneducated and tax uneducated reader understands what is being presented. So what does that mean? Taxes borne I give you a definition from the report. Taxes borne are payments which a company bears itself as a taxable person, which impacts the after-tax profit. So corporate income tax, clearly. Then we also have non-recoverable VAT and so on. So everything that effectively impacts the financial income statement will be considered a taxes borne. But then on the other side, we also have taxes collected. So taxes collected are payment which a company collects from third parties and remits to the state. The best example in Switzerland is that on every dividend that a Swiss headquartered company pays to its shareholder, there is a 35% Swiss withholding tax that is deducted from the gross payment. So that is also a tax that we are reporting as taxes collected. And I think overall, for us, that is a good tool to show to our stakeholder, the investor communities, but also the employees, what the total tax contribution is of Swiss Re in any specific year. Then, so what are the links? I try to link them to the ESG dimensions. So I think I start from the bottom. I think being transparent when it comes to governance means that we have a solid, robust tax governance framework in place. I think that to me is the governance topic here. So we as Swiss Re want to show specifically to investors that we know we manage tax risks effectively and efficiently. We are transparent about it. We also publish our tax policy as part of the Tax Transparency Report, which I understand that Peter is a bit critical about, but I still think it is when we engage internally with internal clients, it sometimes really helps because we can show, we have a board of director approved tax policy, which we need to adhere to. But and I'm sure we're going to have more on that. There is clearly a lot of copy paste when it comes to tax policies. That happened when the UK came out with the new regulation. But I do think the whole process around thinking on how we manage tax risks is relevant and is for a group tax function, but also for a multinational a healthy exercise. The social dimension here, clearly that is where the quantitative numbers come in. So the figures, what do we report? How do we report it? For what countries are we going to report it? And there are two elements of it. One is the public tax transparency, where I said our basis is really the total taxes borne and collected. There is also the country by country reporting, which since I think 2016 we have to do towards the tax authorities. That has become law in Switzerland, and clearly we comply to it. That is, and we expect more push in the future to have that country by country reporting also made public. And then the environmental aspects, I think this is really here. The tax dimension is all the discussion about carbon taxation. I think also green subsidies, incentives. For example, what we're doing here is in Switzerland. There has been discussions about exempting so-called green bonds from the Swiss withholding taxes. So the interest could be paid out gross. So I think that is also an important instrument where a company can help on the environmental side of things. Going to the next slide, which really is giving you a kind of a journey of our tax transparency report, and also mentioning the most important trends that led to Swiss Re eventually do a tax transparency report. I think it all, and I was thinking when I was preparing the slides, can we still have the financial crisis on a slide, since it's now more than 13 years 13 years ago. But I do think it is important, because I think the financial crisis did lay the foundation for BEPS 1 and the country by country reporting. So I do think it kind of changed the perception of multinationals, I think, quite a bit after the financial crisis. And it also then created the political will. Question is whether that was the political will, or at least a will at multinational organizations to come up with specific rules to increase tax transparency, particularly with multinationals. Then, of course, there is the evolving stakeholder interest. I think sustainability is hopefully you can still hear me. ESG is a very important topic for Swiss Re. It also, we found out about 2-3 years ago when we first started to become invited to investor relations discussion. So we had shareholder activists, but also big shareholders in Swiss Re who did ask specific question on how we do taxes, how do we deal with tax risks, why don't we publish country by country reporting, since we now have it. And we really then that made it also very clear that we had to define a clear tax transparency strategy that we can also share with the outside world. And then the last trend is the coronavirus and the economic pressure that will come from that side. I think it's clear that a lot of states had to do emergency funding, and there will be a lot of pressure on multinationals in the future to push for more tax, not only corporate tax, but also corporate tax. I think an interesting discussion here is also what is really meant by voluntary tax transparency, because yes, a lot of what we do, you can say, is voluntary. So we do that. We do the tax transparency report. There is no legal basis yet or regulatory requirement that we have to do that. But since we have a lot of peers, since we have a lot of competitors that started doing it, I do question how voluntary it really is at the end of the day. So when you see that sustainability is an important topic with our group CFO, then we have to become active. So I think that's also something we need to bear in mind. Then certain push and pull factors, which I already partly touched on, but just that you understand them summarized on one slide. Regulatory trends, clearly that is the country by country reporting, which is law by now. There is also the UK requirement to publish the tax transparency, the tax policy, which is a qualitative statement how we deal with taxes, but it is something that clearly triggered a lot of the thinking around tax transparency. Mentioned before, Norges Bank is a huge shareholders in Swiss Re, and we at probably about 3 years ago, which is the Norwegian state-run pension fund. Don't know whether it's only pension money, but has a lot of the oil money in it, let's put it that way. They sent a letter to our chairman back then saying, requesting a lot of information on how we deal with tax risks and how are we going to deal with the request for tax transparency going forward. So that really triggered a lot of internal discussions among the group finance organization. Peer disclosure, I mentioned before, we do have Allianz, AXA, and Zurich doing a lot. Munich Re started to do something, not exactly the same level as we do currently, but of course we can't ignore what's happening around us. If others are starting to disclose, we also have to follow. And I think in that respect, we decided relatively soon that we wanted to really take the lead in the tax transparency area. Our tax report is not 100 pages as Alessandro's, but we clearly were among the first ones in Switzerland and publishing a separate tax transparency report, which was first published in 2018. Then the sustainability reporting. There were the questions in Alessandro's sessions. There is that cost element to it, or cost benefit analysis. I think Harry asked that question. There is a quantitative measure out there. Question is how important it really is, but those sustainability surveys, they ask for questions which we then have to submit, and we are getting a score based on our answers and what we really do in the sustainability area. So there is clearly something where you can put out there and say that is a quantitative measure. How do we compare towards our other peers and competitors? Yes. So how does our tax transparency report look like? So here you see our 2020 numbers. So we have those taxes, that differentiation between taxes borne and taxes collected. Taxes borne are really the taxes that go against our financial statements, about 800 million. And then we have about 1.8 billion of taxes that we collect for different states in where we operate. I think what the first upper graph shows relatively nicely, I think, is that yes, corporate income tax is important. We're not neglecting that, but it's by far the most volatile. So of course, in a year, if you're in the industry of insuring and reinsuring pandemics, it's a difficult business to be in. So that also means that there are much less prepayments of corporate income taxes, because we know the taxable profits will go down. That's just a direct consequence of insuring pandemic risks. So you can see quite a significant drop in the profit that we paid worldwide, from almost 700 million to 400 million in 2020. And of course, that figure I would expect will go down even further, because the losses, as you know, if you have losses in certain countries, you can carry them forward, which means the cash tax payments will be low. Of course, depending on the business, on the profitability of the future business, but it shows very nicely that this is a volatile figure, whereas the rest is relatively stable. It does not really, there is not so much volatility year over year. Taxes collected, there was also one big, actually two drops that we can explain, that we also explained then in the report. When we do share buybacks in Switzerland, we also have to pay the 35% withholding tax. Because of the pandemic, we did not do a share buyback last year, which meant that we had a significant drop in the withholding tax collected. If we're going to do share buybacks again in the future, that figure will come up again. And then the people taxes collected means that we have sold one of our big UK business, Reassure, which meant that we lost about 3,000 people. So I think we were about at 15 and or 16, and at year end 2020 we were at 13,000 people. So that can also explain the drop in people tax collected. Here I want to give you a quick graphical overview how again, we don't have the 100 pages. It also doesn't show you all the pages that we have in the report, but it gives you a flavor of how the report developed over time. So 2018 was the first report that we published. There we really just had taxes borne, taxes collected, and taxes administered plus FTE that we showed. It was the first report of at least in the not 100% sure, but we were clearly among the first ones in the insurance industry in Switzerland that published a report, and it really covered off mainly that methodology of taxes borne and taxes collected. Then in 2018 we started to do a bit more. We gave a regional perspective. We also introduced an introductory remark of our group CFO, John Dacey. I think we made reference to our EBTF membership that Alessandro already referred to. We have in 2019 compared to 2018, we also had a reference to a new low and nil tax jurisdiction policy, despite of what Dirk said yesterday, and I partly agree that there is no clear definition what a nil or a low tax jurisdiction is. We have obtained, or we have drafted, a policy on the use of such nil and low tax jurisdictions. And again, yes, it's not black and white, but you know, sometimes in practice things are not black and white, even though, you know, we would like to have that. So from a legal point of view, I fully agree. You know, you can't. There is no clear, harsh definition what a tax haven jurisdiction means. Still, we need to have something in place internally to make sure that we can give business to steer when they take important decisions. So, for example, if we were to do a fund, a new fund, a vehicle in Bermuda, is that something we can do? Is that still in line with our tax policy or not? And that tax policy has been, our tax policy that we prepared has been discussed with the business and also was approved and endorsed by the GEC in 2019. That's also why we mentioned it in the report. Of course, then we have the yearly comparison in 2019 because we first did the report in 2018. So you see that, you know, was quite a big development from 18 to 19 in just making it more comprehensive, making sure that we also have more senior management attention. In 2020, we had a lot of discussion on what to do with that request for more CBC information. There was quite a lot of discussion internally. What shall we do? We do already partially disclose CBC information for the top 20 jurisdiction by revenue, which also tells a good story because there is no tax haven jurisdiction involved in the top 20 jurisdiction. The question there we really had was, what shall we do with revenue figures, with related party revenue figures? What shall we do with EBT, earnings before tax figures? Is that really something we should already in 2020 disclose in the tax transparency report? There's a lot of discussion among the GEC, also with our group CFO. We eventually decided to do a compromise version. So we do have for certain jurisdictions, we show what our profitability figures is, but we did not do it for the full 20 countries. Just giving you a couple of arguments that spoke against it, and also one that spoke for it. I think the one big concern was really, if we are going to show especially related party revenue, our main competitors will have an understanding of our group, how we structure our group internal insurances, the so-called intergroup retrocessions. And I think that and also the profitability in certain jurisdictions. And we then, after a long discussion, we decided, as long as our main competitors don't do it, we felt that 2020 is not the right time to do it already. There were also discussions with risk management about regulatory concerns. You know, sometimes you have revenues booked in countries that are not insurance related, but a regulator could look at it and think it's an insurance business. So there was also some regulatory concerns, mainly around revenue figures. One thing that clearly spoke in favor of showing earnings as a profit figures on a jurisdictional level were the losses. We had significant, so as a group, we were in a loss in a loss position in 2020. We also had quite significant losses on a jurisdictional basis, and you know, if you have losses and then subsequently loss carry forwards, that would clearly make the tax transparency report and explaining why the corporate income tax figures are lower in the future. That would make it much easier if we were already transparent in 2020 on how the figures look. But all in all, you know, we felt that even though we reckon that eventually we have to publish CBCR information, that we felt that there is too much risk of misinterpretation, too much information that we would give out for free. And I think we also had a comment in one of the last sessions yesterday that it is business confidential information, and we have to be very careful what we give out to the public for free. My last slide, maybe just three main takeaways or messages that I want to get across. I think what we as Group Tax Department of Swiss Re, we decided we want to be the leaders. And why do we want to be the leaders? Because we really think that we can steer the narrative. So as long as we are among the first that publish reports in Switzerland, in our industry, we can set the standards to a certain extent, and that is only to the benefit of us. I think overall the whole transparency discussion will change a lot of relationships with certain stakeholders. So I think it already is different when we talk to the tax administration. They know that what we publish. It is also different when we talk to analysts. It's different when we talk to some stakeholder activists. So it is really something that is a new dimension that we as a group tax department need to take into account when we manage the tax risks. And I think what we also are very convinced of is that tax transparency is here to stay. We do believe that this is not going to go away. So it is clearly something we'll have to monitor very closely and be sure that we take the right decisions, i.e. when is the right time to go and really make this full CBCR table public, and also trying to really influence also the regulatory framework, make sure that nothing that comes out of those new regulations will be to the detriment of Swiss Re eventually. Which means I'm at the end of my presentation. So Peter, I hand over back to you, and if there are any questions, please feel free.
Thank you, Ilan. Very interesting, and to a certain extent, of course, a similar position than Alessandro has, but also there are significant differences. I think there is one question in the chat which goes to both of you, Alessandro and Ilan. Your reports seem very advanced and impressive. Where do we go from here? Is there still room for improvement? And lastly, who were your most important supporters in the preparation of these reports? For instance, the CFO, investor relations, etc. Maybe let's start with Ilan then.
I can, that's an easy one for me. So we have about 80 pages to add in order to get to Alessandro. No, I do think, I eventually, as I mentioned before, it's difficult to really hit the right balance. I think eventually CBC and public CBC will become a topic, and that's where I see it. I think clearly next time when we have the discussion again, we go again with the proposal, or at least with the proposal that we need to disclose more CBC information in our report. I think a lot of, and there was also the question about who is supporting the sustainability guys. So for with us, that's within the risk management division. There is a team called qualitative risk management, and they very much support us in our activities that for really pushing to become the leader in tax transparency.
Well, I was answering exactly the way around, and since what to improve maybe to be more focused and not having 100 pages, but probably 50 pages and more with let's say more focused message and metrics. So because we really try to be as much as transparent as we can, but probably there is a need now to be more focused and give less information and more with more communication inside. What we are planning to do is work a bit on tax incentives, which is something that we didn't touch yet explicitly in our report, probably explaining where and why we are getting some incentives in some countries might be an additional info. And second, really what we would like, it's being more explicit about how to link now the tax behavior with SDG, or probably as I said before, improve our holistic presentation, including tax information in kind of stakeholder report in terms of creation of value. That might be the next frontier.
Okay, there is another question again to Ilan. Could you explain a bit more about the data you were unable to share? I think you mentioned the risk of misinterpretation as a factor, and how you make that choice and communicate that choice to the public. Of course, we are recording this session, so you don't have to tell us your secrets, but in general, how you approach the risk of misinterpretation, because I think it's significant, especially when we look at CBCR, and this has been discussed already in several sessions.
Exactly. So the thing is, as always, when we come with a proposal to TEC members, which we first discussed with our group CFO, we always come with alternatives, pros and cons, and then come up with the recommendation. I think that's just how the world of an employee of a multinational works. And then of course we do pros and cons, yeah. And we are very careful that, for example, I can give you a clear example. Asia and Asia growth strategy is a big topic for us. And for example, which we're also growing nicely, and we show nice growth rates, but it's just part of doing business that you take part of that revenue and bring back to Switzerland, because that's where we pool our risks. And we thought that it could be difficult to explain to the public if we were to do the full disclosure, how does the CBC table compared to our Asia growth strategy. So there are multiple people involved. There is, you know, the Asia people involved. There is investor relations involved. So there's a whole series of discussion that we have before we then finalize our recommendation, which alternative is best to follow.
Thank you. Is there another question? Otherwise, I proceed with one. What was interesting for me to hear is that, of course, you have Norges as one of your main shareholders, but on the slide there was also Ethos as a foundation. And then I would, of course, not call Norges an NGO, but of course, you know, I think for them it's a lot more important to really be sustainable in what they do and how they invest the money compared to, let's say, a traditional investor. Do you see any difference in the discussions you have with the NGOs or enterprise investors that might have more an NGO perspective to a certain extent, in the sense that they really are interested in the fulfillment of the SDGs, and let's say traditional investors? Or are the interests when it comes to tax reporting aligned among all investors?
So, you know, so I don't think you don't count neither Nourish or Ethos as an NGO. I think
well, sorry, I didn't want to make that, but you understand in which direction I'm heading to.
Well, yeah, I you know, the thing is, the discussion we had so far were really mainly investors. So the discussions were very similar. It was all, you know, I think they really, the main topic that they have is the governance point. So they want to understand, you know, who is taking eventually the decision, how aggressive you how aggressive you are when it comes to tax planning and tax planning strategies. I think, and then for me, it looks as if they look at public transparency. The public tax transparency is just a mean to ensure that we don't take too aggressive tax positions.
Okay, great. Javi, please.
Thank you. So, Ilan, another insightful and comprehensive presentation. I really also enjoyed that one. I think give also different perspective, especially when you refer to the sector, which is also the sector that I grew up professionally as well. So the question I have for you, and probably it's also a question for Alessandro as well, is about, we have a misalignment, inconsistency of different requirements. And we know that whether it's a GRI, whether it's the International Business Council of the World Economic Forum, the stakeholder capitalism, which was part of the title of Alessandro's presentation, and we have the Dow Jones Sustainability Index, to name some of them. And of course, we would expect to get the public CBCR from the EU directive, from the proposed EU directive to be finalized. So with all these different requirements, how do you come to a conclusion? What are you going to report first? And secondly, how difficult it was for you to come to this conclusion, trying to satisfy all these different requirements? Do you expect that there will be any sense of kind of alignment, consistency going forward?
Alessandro, you want to go first?
No, you go first.
I have a simple answer. How are you? Expensive advisors. No, I think what you do first is, of course, you look at, you know, first of all, and that's also how it started. You have to fulfill the legal requirements. So, you know, at a certain point, private or the CBCR with the tax authorities became law in Switzerland. So that's when we started off quite a significant and also, by the way, a costly. So that's, Alessandro, why I'm a bit surprised on your comments that it's not so costly. Maybe your cost budgets are then just different than Swiss Re. But for us, that was, you know, the whole process was not cheap, yeah? Because we really had to, when it came to CBC figures, we had to make sure that we have, because we also have different accounting system, different reporting system. We're very global. You know, if you acquire a group of companies in other regions of the world, they keep on working with their own tax reporting system. So it was quite a bit of work to get those CBC numbers together. So I think, you know, to answer your question, Harry, I think it is, first of all, you need to understand what you need to do from a legal and regulatory point of view. And that is where you start. And then, of course, you start to think, okay, what else shall we do? Because we think there are certain weaknesses in certain standards and also legal requirements. And what can we do in order to proactively influence the so-called storyline narrative so that people really understand our contribution to public finances better, and also our approach to tax risk management.
Well, no. One thing about costs, and Ian, it's right to say that the starting point was also for us the mandatory requirements. So when I mentioned that the cost was not very high, I was referring to, let's say, make the next step, which was adding the cash information to the, let's say, bulk of information country by country that we had in any case to build up for mandatory reasons. So in case it's mandatory, nobody is asking question about the cost, in the sense that you have to do it. You try to do it more efficiently possible, but the cost is there. And the additional, let's say, information to have the report that I presented was not so important. I mean, that is a good point to explain. Our approach was, of course, when you have so much sources, it's that you have to take your way. In the sense that we decided from the beginning that the total tax contribution approach was for us the best one, in the sense to present the attitude of the company to taxes. For us, it was important to explain the different taxes you pay, what kind of business you are doing in that country, to give, let's say, an understanding and a framework in which you can interpret the taxes you pay in that country for that kind of business. And then we just added trying to be in line with the GRI 207 when they introduced also the country by country specific information. We were just trying to add whatever was for each country needed to comply, and in cases there were some overlapping or contradiction, we were just taking a decision what was for us meaningful to do. So it's very pragmatic way. Then the need of a standard. For me, it's really key, fundamental. It would be really very, very important, I think, for multinationals to have a clear standard, so that everybody can report based on different, let's say, industry specific, but can report following a standard, so that everybody can compare things. And there is no misunderstanding. You are presenting this information, or you're not presenting this information because you are hiding something. It's simply because you don't think at this stage that it is interesting. Of course, if there is a standard, you follow a standard. So for me, it would be really, really important, and I expect that sooner or later a standard will come out. Probably it's not something that is coming tomorrow, but I think it's really needed.
Thank you. Yes, and that's also one goal of the conference here, already to start, assessing existing standards, what is good regulation, what is bad regulation, and I think we continue in the afternoon. Many thanks, Ilan, and again, Alessandro, for both your presentation. I think they were really interesting and gave us a great insight into industry-specific topics on tax reporting. So having said that, I think we close the session here. We meet again at 1:10 in the afternoon. I think it's the same Zoom link as this one, but the session might be closed, and so you have to re-enter the conference in the afternoon. So see you in 1 hour from now, and thank you again, all the participants.
Thanks a lot.
Okay, I think let's start. As usual, people will join us a bit later. We have 2 sessions left this afternoon. The first one by myself, and then the second one by Eelco van der Enden. As we did previously, if you have questions, just put them in the chat or raise your hand during or after the presentation. I again have to apologize a bit because of my personal circumstances within the last week. I did not really have time to prepare, as you know, because of COVID cases, our childcare was not available the last few days. So I was basically playing soccer outside, and I should have, you know, drafted the slides a bit more in detail. So if there are any typos on the slides, please apologize. Okay, so let's start. What is my goal today? My goal today is to focus on one aspect that has not yet been discussed in detail during the past 2 days, and that goal is to focus on the SDGs. I guess Florian and Thomas have shown already, you know, the slide yesterday. That's basically our theory that we follow at our institute, and that you know, we have to be careful when we look at the various tax reporting obligations, that we distinguish between recommendations that are necessary that your business develops, so the value of your business. This is what we call the business development rationale, and we have discussed that especially this morning together with Sebastian and Florian on what is important from an investor perspective to have access to in order to assess what the value development will be of a company. So for instance, what is important to assess what is the regulatory risk of a company, or what is the reputational risk. And I myself will focus on what we call the comprehensive development rationale. So that's on the right side of the slide. So what is the link between the current tax reporting obligations and the SDGs? Now, it's really important that we put things into context here. I'm not going to discuss, you know, what is a fair tax system, what is a just tax system. The only thing I'm going to discuss is what is the relation between tax reporting and the SDGs. Because the SDGs, that's the global consensus. You can agree on that, but it is a fact that the United Nations have agreed on fulfilling the SDGs until 2030. So I'm not going to challenge that. My goal is simply to assess what the relation is between tax reporting obligations and the SDGs. Okay, so here, of course, is an overview which is not comprehensive, but we have already seen that over the past two days there is a channel, a regulatory channel when it comes to tax reporting, and that's also one goal of the conference here, in order, you know, to be a starting point of further discussions of how tax reporting obligations should be designed and whether there should be a harmonized standard, as Alessandro mentioned this morning, because that's also my personal feeling that you know, a harmonization would be great, because you could then definitely also compare companies and industries, which is not the case currently. What we have tried to do in a very simplistic form, and you find our working paper online on tax reporting and sustainability, we have tried to put the various standards into a matrix, on one hand between what is private and what is governmental, because that's interesting as well in the area of tax reporting. You have private standard setters, you have governmental standard setters, And if you look at the standards, some might be more in line with a business development rationale, and others might be more in line with a comprehensive development rationale. Now, the categorization is very simplistic, and we would need to do a detailed analysis. And of course, some of you might already know parts of the slides, because I have used them also for other purposes. Now it gets interesting. If we look at the recommendations, and I have counted up to 50 different recommendations. So if you look at the different standards, be it GRI, then you have up to 50 different recommendations on what is recommended from a tax perspective to report. And if you categorize these recommendations, you come up with the following categories: tax governance, tax planning, awareness. These are things we have discussed today and yesterday. Support and enable an effective tax system, legal compliance and beyond. That's the OECD approach. Transparency, relationship with authorities. Now, I highlighted two categories that prima facie you would say, well, that these are the least important ones: relationship with authorities and support and enable an effective tax system. The other ones are the more traditional ones. And if you look at the other ones, so tax governance, tax planning, one of the main ideas behind these categories is, to reduce tax planning opportunities, and maybe also to force multinationals into a higher tax payment. And the other two highlighted categories, relationship with authorities, support and enable an effective tax system, are a bit different. And my personal feeling, and I will try to argue in that way in the following minutes, is that these are actually the categories that we should focus on if we want to link tax reporting obligations and the SDGs. So these are the important categories, not the other ones that prima facie seem to be important. That's the argument I want to make in the following minutes, but more details will come. Okay. Now, why two elephants? Why two elephants? And the argument is well known. And we have one extreme elephant in the room, and that is state spending. So if you look at the payment of taxes and its impact on the SDG, you have always the state in between. And this has also been discussed this morning. It's very obvious. So if you pay €1,000 of taxes, you don't know how much will end up as an investment into the improvement of the SDGs. It can be 500, it can be 1,000, or it can even be 0. So the hypothesis number one is that the impact the payment of taxes has on the fulfillment of the SDGs is really overrated. So is the impact of tax reporting for the purpose of achieving SDGs. It depends on how the state spends its money. Sounds very obvious. Let's make an example. But before we go into the actual SDGs, here is an interesting approach. You have also ESG ratings of countries. And not surprisingly, the developed world is rated quite well. So Sweden, Finland, Norway, and some of the poorest countries receive the worst ESG rating. And these ratings are also used for governmental bonds, etc. But what does it mean for us? Does it mean it's better to pay taxes in a well-rated country, or does it mean that it's the opposite? And here I'm a bit struggling. And how can I solve the problem? Well, my personal belief is that we really have to focus on each SDG individually. Why, or individually? Why is that? One problem is that with respect to certain SDGs, there is just no room upwards. So in many jurisdictions, for instance, the indicators of SDG 1 and 2 are fulfilled. So 1 and 2, that's no hunger or no poverty and 0 hunger. So in my country, for instance, Switzerland, we have achieved 100%. Okay, so there is no room for improvement if you look at the official indicators of SDG 1 and 2. However, in very few countries, on the other hand, the problem of hunger and poverty is extreme. And I again focus on SDG 1. So let's start with the statistic on the right of the screen. There you see that 3 countries account for 1/3 of the global number of poor and hungered people. So that's Yemen, the Democratic Republic of Congo, and Afghanistan. So what does that mean? Well, if you want to improve SDG 1 and 2, the argument would be that mainly tax payments in these countries can help. However, only if it's proven that the tax payments indeed help to improve the situation in these 3 states, then the argument is valid. So this brings me to the second statistic on the left. It shows the most important cause of hunger is conflict and insecurity. Now, these numbers are from the World Food Program, and together with economic shocks, you realize that hunger and poverty is man-made. Okay, so states are responsible for hunger and poverty, or at least human man-made conflicts. There you see the significance. So what does that mean? It means that on one hand, we argue that you should contribute more, but at the same time, states are at least partly responsible for poverty and hunger. So therefore, it is not only not clear what the impact is of €1 of taxes on the SDG, but it is also, it seems also that €1 of taxes can even worsen the situation. And now I make a very extreme example, and it might even be misplaced in an academic debate, but sometimes I guess it is good to over-exaggerate to highlight the actual problem at stake. And the actual problem is, also governmental responsibility here. And what you have in front of you is an outline of the war costs in Afghanistan, US only. So the official cost of the war of the US in Afghanistan, it amounts to $2.3 trillion US dollars. Okay, $2.3 trillion US dollars. Now, it is, of course, a common position that this was not well invested money because the situation has definitely not improved in Afghanistan. And we have seen the number of poor people and people in hunger situation is extreme still in Afghanistan. Now, let's put that into perspective. And of course, it's really an over-exaggeration, but I want to make the argument in order to demonstrate you that it's too easy to say, pay your taxes and it's good for the SDGs. So what you have here on the left side, these are the war costs on Afghanistan. What you have in the middle, that's the revenue gain from Pillar 2 as estimated by the OECD. Now that's a bit frustrating because the first 30 years of Pillar 2, will not even be equal to the costs, the war costs the US taxpayer borne in Afghanistan. I mean, that shows the frustration if we simply ignore state spending in a discussion about tax reporting and SDGs. I know, again, it's an extreme example. It's really just to help to make the argument that state spending is important. Now, let's get back to the topic here. And what I outlined on this slide here is factors that play a role for the sustainable development of an economy. And this is derived from economic studies. So these are factors that are important for a state to develop, economically mainly, but of course that means de facto also that many of the SDGs will be improved. And here you have things like voice and accountability, political stability and absence of violence, government effectiveness, regulatory quality, rule of law, control of corruption. Now you could say, well, what's the relation here with tax reporting? Well, that's exactly the discussion we should have. We should, review what is the relation of our own tax behavior as a multinational and these factors. And maybe let me make an example here. As an M&E, you might be able to influence the regulatory quality in a jurisdiction, and this factor can definitely positively influence the development of a state. So it's not about the tax payment, it might be about the regulatory effectiveness. Or secondly, as an M&E, you can try to avoid the corruption-like situations in these states, and this will definitely have a positive impact. And this is why I think we need to shift the narrative a bit in tax reporting situations. If we really want to improve the SDGs, we need to figure out what is important to improve the SDGs in these states. And two factors here, there you see a link between your tax behavior and the development of the SDGs. Okay, so first conclusion here, more reporting is per se not more sustainable. And again, I'm focusing only on the SDGs, okay? I mean, there is an argument in favor of more transparency, more reporting obligation when we come to the investor perspective, in order to figure out whether a company will develop positively over the next couple of years. But if we look at the SDGs, I don't see that there is per se an argument in favor of more reporting. But we need an assessment of what reporting standards could indeed have a positive impact on the SDGs. That's a very challenging discussion, but I think we cannot simply avoid it by saying, well, it's good if you pay your taxes and everything will be all right. And that's not an empiric statement. Okay, so let me move on to the second elephant in the room, and this one is maybe less comprehensive and more specific. And by more specific, I mean SDG number 10 on reduced inequalities. So one SDG should focus on a reduction of inequalities, and such SDG has been present all over the place, also in the BEPS discussion, in the discussion on Pillar 2. But my personal view is that tax incidence is the second elephant in the room, and if we focus on corporate income tax, we are simply misplaced, because we still don't understand who is really going to pay for corporate income tax if there is an increase in your corporate income tax burden. And this is interestingly also someone already colleagues discussed this morning, the corporate income tax seems just to be a strange measurement, especially if we focus on a reduction of inequalities. If we really want to focus on a reduction of inequalities, we have to focus on state spending again. And the corporate income tax rate just does not say anything about whether a state is going to reduce its inequalities or not. So hypothesis 2 and 3, the fair share argument that is very common, is very difficult to uphold for M&Es, that it is highly unclear who bears the tax burden. I mean, are you going to reduce salaries if you pay more corporate income tax rate? Are you going to use less effective production factors if you have to pay more corporate income tax? It's just a very difficult discussion. And hypothesis number 3, the impact of corporate income tax on the reduction of inequalities is overrated. Again, my argument is many of the current recommendations have simply no link with the SDGs. So the rationale might be different, yes, fair statement, but I think we should not overestimate that the current reporting standards will do a lot good in relation to the SDGs, because of, inter alia, the two elephants I just described. So what should we do? I personally believe that we should assess each recommendation, and I learned this morning that probably financial reporting is better when it comes to the business development rationale, and it makes absolutely sense to use financial reporting obligation in order to give investors really clear guidelines on what to expect if they invest into a company. However, if we look at non-financial reporting obligation, then the story gets a lot more difficult. And what you have here is a matrix. Again, you have the business development rationale and the comprehensive development rationale. And each of the recommendations you would need to put somewhere into the room. 2 examples: published tax strategy. I simply don't see any relation between the publication of a tax strategy and the fulfillment of the SDGs, because inter alia of the 2 elephants, just mentioned. So that might be good for your business development, but not so sure from a sustainability perspective, from an SDG perspective. That's simply window dressing. Currently, that's simply window dressing, and I think it's important to you know, outline these recommendations in the room you have in front of you. Second example, no tax bribes. That's also one of the recommendations in some of the standards, and I think that's a very good recommendation because, as mentioned, corruption is really, really bad for the development of states, and that's also empirically proven. So you should avoid at any cost to have corruption-like situations in your multinational. And we should focus on these recommendations if we really want to, you know, improve the SDGs. And that's my main argument, because otherwise, if we have just a huge amount of data available, we might even forget to focus on the right ones if we want to improve the SDGs. So less is likely more. Probably that's my position, and of course I'm more than happy to take questions and to discuss the topic. But again, less is likely more if we focus on the SDG. And that was my task now today for the presentation, really to put that perspective also in front of you. So if you have another rationale why you want to have tax reporting, well, that's perfectly fine. If it's about business development, etc., why not? But with respect to SDG, I think we need to be careful not to mingle arguments and not to, you know, mingle rationales here. So by having said that, I'm basically at the end of my presentation, just again to highlight the two categories that I think there is a lot of room actually to have a link between tax reporting and SDGs. However, these are the two categories that are often not so important currently. Okay, thank you. That was it from my side. And now I have to moderate my own session. Any questions? Yes, Frederick, please.
Yeah, thanks a lot. It's not really a question, but more an attempt maybe to enlarge the debate to some other factors also in the SDGs. So I think the starting point of your argument was that tax transparency or tax reporting would lead to higher corporate tax payments, or that this would be the consequence. And then we're not sure whether this contributes to any SDG. So I would principally agree that, yeah, we don't have a lot of evidence that this is indeed the case, which I think you showed quite well. But I'm not sure whether more tax reporting would necessarily lead to higher corporate tax payments, or this is the principal rationale for that. So I think one different rationale that is possible is that this just leads to more if we have information about important tax variables of enterprises, then we have a lot of more information about how tax systems work, what is the effect of certain policies in practice. For example, what kind of policies lead to what kind of tax payments. So at the moment, it's often, especially in I think developing countries, there's very few information available about what kind of policies have what kind of effects, and also often like government agencies maybe lack specialists that are able to really evaluate policies. And if you have more data, so the hypothesis could be that this leads to tax policies that are more effective, not necessarily from the point of view of generating more revenue, but they could be better at achieving certain aims just by raising analytical capacity, and you can link. And if that's indeed true, which of course can also be debated, I think then you have a link to the SDGs, which call, especially in SDG 16, for more inclusive policymaking institutions and better decision making. So this would be just one proposition, and I would be curious to hear your thoughts on that.
No, thank you. I would agree, and of course I was rather provocative in how I approached the topic. I'm just a bit disappointed with the current discussion, because sometimes if you read newspapers or also academic publications about tax reporting, there seems to be a common agreement that what we are doing now is good for fulfilling the SDGs. And I simply don't see that. But I get your point that having more data available, of course, can have a good impact or a positive impact on legislation. Thomas, please.
Yes, thank you, Peter. Well, as you know, I'm a little bit familiar with your ideas, but one question comes into my mind is the following. From a business perspective, I think you make it quite obvious that we should be very, very careful to make the link between a good tax policy or tax strategy, good taxpayer, and the sustainability goals. I think you make it very, very clear. But on the other side, we were talking about the state as the elephant in the room. Do you have any ideas or any remarks from the state or the regulatory bodies, the lawmaker? Do they really see the problem as well as we from the company perspective? Or because for them it must be a little bit disappointing, isn't it, that they are saying, well, we need more tax payments and then we can fulfill our sustainability goals. And you show and make it very clear, well, that it is obviously not that easy. So to make it sure, is there any reaction so far from the lawmaker, the regulatory perspective on your ideas?
No, not really. Not really. I mean, the standards are there, and I think we have all realized over the past two days that it's a very dynamic and a very dynamic topic. And I think it's also sometimes, a fight for regulatory power. And maybe there will be a consolidation in the next couple of years. And my personal hope is, that standard setters will be transparent when it comes to the goals of their of their purpose of their standard. Because I showed the matrix in the beginning, whether a standard follows more a business development rationale or a comprehensive development rationale. I think from the perspective of a standard setter, it should be clear from day one, what is our goal? So are we designing a standard in order to help investors to see what will be the sustainable value development of a company? Or are we defining a standard which will help to achieve the SDGs? And I think it's even dangerous if we mingle the two, because it gives the public the perception that we are now doing something good for the SDGs, but actually we are not. And I'm rather open for a broad variety of reporting obligations, but I think we need to be transparent on what our goal is here. And as was discussed this morning by Irma and Alessandro, if you're not in a developing country as a multinational, if you're not active in a poor country, well, your impact on SDG 1 and 2 might be very limited, because as we have seen, for instance, a third of the poor people, according to the SDG indicators, live in 3 countries. And it's not that there is not enough tax payments there, it's man-made, it's because of conflict, etc. And I think we need to have a lot more understanding. And sometimes I feel like a student who does work on development economics, because I think tax law, somehow we are shifting into development economics if we talk about these recommendations. And I take up one question from Marlene Parker. I agree that higher corporate tax will not assist with SDGs. However, for developing countries, the options for financing the SDGs are extremely limited. ODAs are falling. What do you think are the best options for developing countries to finance SDGs? Now, one important issue that we are also partly dealing with, and Irma and myself are in contact with the UNDP, so with the UN Department on Development. And what they do is they do budgeting for SDGs. Budgeting for SDGs. So basically, as a government, you have your budget and you try to figure out in which SDG you have a lot room for maneuver against low costs. So, and each state is different. So for instance, if you are a state with a lot of consumption, such as Switzerland, and consumption is bad from the perspective of the SDGs, because overconsumption is bad for climate action, for climate change, for instance. Of course, the focus should be on that area, because there is the area where you still have room. But if you're a developing country, maybe you have room with respect to education. Well, then you have to figure out, is it better to invest one tax dollar into education or one tax dollar into reducing poverty? And I think we sometimes overestimate our own position as tax lawyers. At the end, the spending side, I guess, is a lot more important than the revenue side. Okay, taking up another comment by Werner. Publishing a tax strategy was presented to be seen as window dressing. What would be the views on the publication of a tax strategy progress report, where a company explains what they are doing to live up to what is mentioned in the tax strategy, which includes the activities around supporting the UN SDGs, such as advocacy? Well, again, I'm open there, and if your tax strategy contains elements that make a direct link to the fulfillment of the SDGs. And for instance, that can be a statement, that you help countries in need to develop a regulatory framework, advocacy, or that you're really trying to avoid any corruption-like situation, and that's part of your tax strategy. Of course, then it's not only window dressing. So I was maybe too strict there. Any other questions? Irma.
Yeah, perhaps just to say that I agree with you, and I think that there are 2 points that we need to make here, and we started yesterday saying the amount of transparency initiatives and how much reporting are you taking out to the business and how much the countries are being able to use. And at the same time, the dialogue that should be between the business and the tax administrations in the countries, and seeing also how this will, the SDGs, how will be met, because that's also the problem. We say there is a lot of money, there is a lot of reporting, but what happens in practice? And that's something that we really need to see whether this is the second step, should we say. So now everything is reported, but what we do with that, but also take another level of discussion.
Yeah, because I firmly believe, for instance, that multinationals have a huge power also when it comes to fighting corruption. So if there is a common approach, also documented by reporting, how you deal with tax authorities that are still at least corruption-like, and these situations exist, then you can also solve the problem of corruption. And corruption is so bad for development that we don't even have to start about, talking about tax revenue. I mean, corruption is a lot more detrimental than any tax planning strategy in the world. So I think we need to focus on such areas if we want to, again, if we want to improve the SDGs. and we have to be clear on what is the goal of our reporting obligations. Okay. Any other questions? And sorry for the, I think the Afghanistan slide is a bit misplaced, but I thought it's it's food for thoughts. So don't get me wrong there. It's really provocative only. Okay. then I think we close the session here, and then I check whether Eelco is already among us.
I am amongst you.
Great to have you here. I'm a bit earlier than according to schedule, but is it fine for you?
That's fine for me. I'm looking at the camera. So I have a start video. Yes, here I am. Well, if technology will work, then we have a colleague of mine, Bronte, that will put in place my presentation. And what I would like to do, and if I can get this, yep. I would like to start with slide number 4, ESG standards and guiding principles. And I would like very much to demystify the reporting landscape, and also explain that some of the parties you promoted to standard setters on your first slide are not standard setters. They provide either guiding principles or a framework for governance, but they do not set reporting standards. That is, if with standard setting you mean reporting standards. If you look at this slide, and you see, and that's what usually also called the alphabet soup in ESG and sustainability. But there are a lot of organizations that are self-proclaimed standard setters that do not set standards, but provide guiding principles. So one on the slide was also B-Team, an initiative that I very much like, by the way, of course. But it sets 7 guiding principles on what good tax governance look like. And top of my head, principle number 7 is about transparency. It does not tell you how to report. The major standard setters in the world currently, when it comes to financial and non-financial reporting, are of course the IFRS Foundation with its International Accounting Standards Board. In the United States, we have the Financial Accounting Standards Board. These bodies set financial reporting standards based on the concept of financial materiality. And they have been designed for investors with the purpose of providing comparable data for investors on which they can make a justified decision on investing or not investing. And in the good old days, when the world was very simple, 2002, it was only the concept of financial materiality that counted. And financial materiality means the monetary effects of the reporting entity itself. And that still is the case with IFRS, International Accounting Standards, and that still is the case with financial accounting standards. And for tax, then we have, of course, the famous IAS 12, and in the US we have ASC 740, and that is based on financial principles. If you now look at the landscape of ESG reporting, non-financial reporting, as some say, but we get to when it gets to double materiality and financial reporting and the effects it has. And by the way, let me stress, paying tax by itself will not help the world, of course. It is what you do with the money, and you need an infrastructure with proper institutions that are able to act responsibly, and just giving money is not a solution. It needs more. But going back to the reporting landscape, non-financial reporting or ESG reporting, they're basically two serious players, or two serious. One is the GRI Foundation. And GRI was founded in 1997 in the United States. By the way, it's an American initiative. It's not a European initiative. It comes out of the US, although the headquarters is currently in Amsterdam. And the other one is the Value Reporting Foundation, which its major member, the Sustainability Standards Board. That is SASB, Sustainable Accounting Standards Board, I have to say. They merged with the Integrated Reporting Framework, which is also not a standard, but a framework. And the current landscape is developing as follows. In Europe, we have the EFRAG, the European Financial Reporting Advisory Group, which is a European body, but which is, its secretariat is for 95% manned by professional accountants from the 7-8 large accounting firms. And EFRAG is the body that has to execute upon the European Commission's initiative around the Corporate Sustainability Reporting Directive. So they are designing now and setting standards, ESG standards, in a European context that will be mandatory as from 2023. On the other hand, you have the International Accounting Standards, you have the Financial Accounting Standards Board, and you have the IFRS Board of Trustees. IFRS Board of Trustees, they came with an idea also to incorporate ESG reporting into the framework of the International Financial Reporting Standards. And they have decided to incorporate a so-called International Sustainability Standards Board that will be the brother or sister of the International Accounting Standards Board. And they will be made responsible for ESG standards. And the first one of them will be on climate. So then what is the big difference between the European initiative and the IFRS initiative? And I would like to bet with you a great bottle of wine that in 3 years we will have an international body aligning the two standards. That is on the topic of materiality. And that's where it also hits your presentation. So the IFRS Foundation, everything set for investors is based on financial materiality. The European standards with the cooperation agreement and co-designing agreement with GRI is based on double materiality. So it's not only financial impact of the reporting entity itself, but it's also the impact the organization has on climate and society. And by default, that's more difficult to measure, so to speak, on a short term, because there is no quantitative and qualitative framework yet outside climate. So jokingly, if it comes to human rights reporting, GRI 401 to 4019, how do I measure that I meet the basic principle of the United Nations Declaration on Human Rights? By reporting that I have whipped my staff 50% less than last year or something like that. And by the way, this human capital reporting will be one of the first two pillars of the European mandatory reporting requirements. So the first one is climate, and they published yesterday the first draft, and the other one will be on human capital. And let me give you an example how that works in practice with some organizations. So there are organizations that are engaged in palm oil and that have palm oil plantations. And most of these organizations have signed up to GRI charters on human rights and report on human rights. So we do not make use of child labor. We provide equal payment to all. We have social inclusion, etc., etc. But how do you measure that you do that? Well, in case of some palm oil companies, and it literally for an external auditor happens like this, they have a framework and a system in place whereby they monitor with drones the palm oil plantations, where they have independent external auditors doing unexpected visits to see what the employment conditions are of the workforce working on the palm plantations and stuff like that. And I would dare to say that that helps to achieve the Sustainable Development Goals. But I agree with you there, that's not tax. But it is not financial reporting. It's extremely fascinating to see how things are developing and to get to this reporting landscape. So it's not that difficult. So you have IFRS financial reporting, they will be also on climate. And you have Europe, which will set the global standard for, let's call it, although it's wrong, non-financial reporting with help of GRI. And they will perfectly fit together in two pillars with one overlaying body that I expect will be manned by World Bank, IMF, United Nations, PRI, and IOSCO, ESMA. And they will be able to perfectly work together in this new, let's hope, aligned, very clear reporting landscape, which will drive value growth, value creation, and which will put down the tremendous cost of compliance that would otherwise be involved for business, which benefits no one except the likes like me that advise on it. So the elements that what I would also like to stress here, this has not been invented, also non-financial reporting, just to tease or make life difficult for business. Also GRI, and the tax standard of GRI, for example, has been requested by large US private equity investors. Not by NGOs or some leftish hippie-like type of organization, no, by private equity investors, because they wanted to see comparable data on tax. And not only how much you pay, no, they want to see what the management appetite, the risk appetite of management is towards this field. Because there is a notion that certain tax behavior triggers negative relationships with certain states, with certain governmental bodies. It tells you something about the quality of the profits, of the business profits, and it tells you something on the quality of the risk and control framework. So that's why it's a quite comprehensive thing with these three elements. Again, not initially built or designed on behalf of a request for NGOs like Tax Justice, no, on request of private equity. What we also see, because there you see on the right side, ranks and raters. That's what is relatively new, is that rankers and rating agencies, the MSCI, the Moody's, the Bloomberg, the Standard & Poor's, etc., 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 they are now taking tax into account more and more and more and more. And also not because they see tax as a tool to achieve the Sustainable Development Goals as such. No, it's for the quality of the profit and the risk profile of those organizations. Why is that important to see? And then let's go to the first slide, Ron, please. And if there are any questions or disagreements, please. Other slide first. Up, 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 up. This is the set up. Yes, this is the one. Thank you. So what we currently see happening, and what I would like to stress is ESG is no longer a nice to have thing for your public image. It is becoming mainstream business. This move you see from shareholder to stakeholder capitalism is in fact happening. And I will share with you some examples also why it is happening. But looking at investors, and how they look at the ESG landscape. There are some things happening that will also push business more towards ESG type of policies, also for tax, because if not, then the entering the capital markets will become more expensive. Currently in Europe, the invested capital in ESG funds amounts to 2 trillion euros, that is. That is between 17 and 20% of total capital invested. By 2025, it is expected to be between 57 and 60%, which is 5.56 trillion euros. And that means if you have these linking vessels, that all the money that is invested in ESG rated funds, and well, we have the European taxonomy, we just had the BlackRock report. By the way, the BlackRock report for the financial services market and green bonds and sustainable finance now is also, it was published 2 weeks ago, exactly 2 weeks ago, on behalf of the European Commission, also says that for investors, the double materiality principle is of importance. And there should be built a framework around this concept to easier get access to what is behind it. But we get to that in a couple of minutes. So, but by default, the amount of funds available to invest in organizations that do not meet certain ESG principles or criteria in the view of the funders, investors, and rating agencies will have to pay more to attract the money out of the market because there is less available, because more is going into the ESG funds. And we see that already happening. It's more difficult to get money for not ESG ranked organizations than for ESG ranked organizations. So it's not only about marketing, it influences your ability to attract capital from the capital markets. So if we now understand that there are standards and guiding principles and raters and rankers, then the ESG environment gets a bit more, well, let's say, more tangible. So now we are going to try to link it indeed to tax and to tax practice. Next slide, please, Ron. What does it mean? Well, having heard the presentations this morning from Swiss Re and it was, how can I forget? Well, okay. Yes, I was absolutely happy actually with the knowledge and the ideas behind it. And I can tell you that businesses at this moment perhaps understand better what ESG means than their advisors when it comes to tax. Why? Because they work in an environment that each and every day they're confronted with these questions and making choices. So what it is, the purpose beyond value growth for its own sake, which is basically, again, the double materiality principle and the fiduciary duty towards society. So is this entirely new? Do we see here what you sometimes hear like a paradigm shift? And will it explode cost of compliance of all these organizations? And I dare to challenge that. At this moment, there are a bit more than 11,000 multinational operating companies that follow the GRI standards. All these organizations either report also under financial accounting standards, IFRS standards, or FES standards. So basically, they already do it. The only thing they do is they report on ESG on a voluntary basis. And that is what in Europe will change. It will become mandatory. But Europe was, thank God, smart not to design an entire new framework. No, they use the due process and principles as set out in GRI standards. So there will not be that much change for businesses in the European context if they already report under sustainability standards like either GRI or SASB. Then why is Europe doing this? Because they think that by ESG reporting, they can influence behavior of businesses. And there I am with you. Is that the fact? Will tax transparency and tax reporting lead to less tax planning, evasion, fraud, or whatever? I have no empirical evidence, but by itself, I think it will not. I think you need a framework, a comprehensive framework, preferably global, where all different elements, which is reporting, transparency, but also the tax system, needs to be changed to a more manageable, user-friendly system. What is new, of course, is that tax has been suddenly deemed an ESG metric. What does that mean? Well, it means for businesses, basically, that if you were looking at tax, and we have a slide on that, out of a cost compliance factor only approach, you are suddenly being confronted with things like climate and impact on society. And that is new, because we as tax people, by the way, before joining PwC, I used to work as head of tax, treasury, risk management, and corporate finance. In my days, tax was a cost factor only. We were only looking at tax as a cost factor, and we had to be compliant. And now suddenly we also need to somehow measure what the impact on society is. And we see that governments look with a new lens again to tax. So it's not only for revenue, it's also for behavior as a driver, as a means for behavioral change. Then we are in the E of ESG, environmental taxes. We built what we call the Green Tracker, and it's a platform where we stored the information of 85, 90, I believe now, countries of all the environmental tax initiatives, the carbon taxes, greenhouse, plastic, water pollution, etc. I stopped counting last week. We are at somewhere like 3,150. And there are now like more than 800 type of incentives for businesses to transform from fossil to sustainable production capacities and energy. So that's typically the E. It's carrot and stick. Tax what is bad, and you reward what is deemed good. By the way, in the good old days that you all know, and there were this morning by Enel also there were mentioned some countries, of course. Countries were competing with each other to attract capital with tax rates and with tax holidays and stuff like that. What you now see happening as a trend is that they use other tools, and those tools are green incentives. The data centers in the north of the Netherlands take up 13% of all the solar and wind energy produced in the Netherlands at a very, very, very low price for the data center. Why? Because they were granted a right to use it for 10 years at that price, which is not a tax incentive, but which is a different incentive. Then the question, of course, for you legal people will be, isn't that an infringement of European non-competition law? I don't know, may very well be, but people in this case don't think it is bad. So when you pay less corporate tax because you have a special arrangement with the country, everyone will say, oh, that's bad because it's not a level playing field and you have to pay your fair share and stuff like that. But if you get a reward via a different way in order to produce or use sustainable energy sources for the production of whatever you do, then people will not complain. So from a political, tactical point of view, attracting foreign capital by using the instrument E of environment in such a way will make you far more happy. Then, of course, we have the G of governance. This is often a bit difficult. And it was mentioned before, of course, that we had this the issues with corruption. And the issues with corruption are, of course, huge. And paying more tax to a corrupted government will not help achieving the SDGs. I am fully on board with that one. There you have to find different means. And I was one of the compliance officers of the Dutch Good Growth Fund. What you sometimes see breaks your heart. Very sad indeed. Not solving these issues, E, S, and G, and there we get to double materiality and not only financial value reporting at this moment. And I've seen that Annelies was also at this meeting from South Africa. South Africa is, of course, a good example of what happens if the E, the S, and G are not being taken seriously by governments. It will lead to massive capital destruction for businesses themselves. The lootings, the rapings, the murders that happened like a month ago come forth by the endemic corruption there was under the Zuma regime, come forth under a collapsed tax system and an inequality on a near unprecedented scale, the lack of social inclusion and lack of development. So the social element and the governance element in South Africa were so bad that it triggered a public outrage. And that public outrage vented itself on large shopping malls and businesses, costing them billions. And by the way, billions of investments in South Africa. So I dare to say that we have to take this very serious indeed. Why is tax an ESG metric? The easy answer would be just to say, because in the report of the World Economic Forum and the International Business Council to the World Economic Forum, it was mentioned as such in core metric 22. You know this report, 22 core metrics is on ESG, and strong advice for the 140, 120 largest companies in the world to indeed start reporting under these 22 core metrics. And what is deemed a core metrics, not by me, but by the World Economic Forum and the International Business Council, something you already report under, or that you can relatively easy extract data out of the organization to start reporting under. And then suddenly tax was mentioned as core metric 22. By the way, the proposed standards to be used by IBC, World Economic Forum, some 18, 19, so 80% of the core metrics, it is advised to use the GRI standards to report, which is again double materiality, which is by itself then of course not that strange that the EU will also take that on board. So why is tax an ESG metric? I think because there is more at stake. We know we use tax carrot and stick for redistribution of wealth and as income. That's what makes it so politically difficult. But you see now that we are facing huge budget deficits. So tax is high on the radar screen of governments. Look what happened in the UK yesterday. Increased massive tax increases. So apparently stepping out of the EU was not that profitable. Sustainable growth, achieving the sustainable development goals. And I completely agree that just paying tax by itself does not create a better world. You have to use it wisely and responsibly. A driver for change, the amount of and that would be a very interesting piece of research, I think. If you look at environmental taxes, let's use carbon tax. Let's use carbon taxes. Perhaps you knew that in November 2018, a ton of carbon costed you €7.50. I believe today it will cost you 55. And by 2023, it will cost you 195 euros per ton. And what could be interesting is looking into these environmental taxes and see if they currently yield more revenue for states than corporate taxes. And somehow these environmental taxes are quite, well, call it heavy from a investor point of view, I would say. They form part of your operational costs. They are not a below the line item like corporate tax. They cost you your operational margins, which makes them, I would say, very important to manage well. Here is also something that I would like to stress on the E and the environmental taxes. That is, I dare to say, well, funny. I always say to my team that we do aggressive tax planning to save the world. The less carbon taxes you pay, the less plastic taxes you pay, the less greenhouse taxes you pay, the greener you produce, the better it is. Unless, of course, you dump it all illegally somewhere else, but assume you produce clean. The cleaner you produce, the less tax you pay, the better it is. And I would dare to say that using these environmental taxes as business to report to public, to stakeholders, that you see the amount of environmental taxes paid is decreasing, is nearly a validation of your net zero promises or whatever green policy or strategy you may have. So I predict that we will see separate green tax reports to underpin the initiatives of businesses when it comes to environmental issues. So it's a big danger. Then the cooperative compliance, trust and transparency. The trust element in the tax system is very important indeed. And the trust element between tax administrations and businesses also. And I can't stress more that a world based on a bit trust and more cooperation with each other would be a far better place. Is that difficult? Yes, it's difficult, because tax is, of course, a very, very politicized environment nowadays, but we should keep pushing for a cooperative compliance type of arrangement. And then the stakeholder capitalism, shareholder capitalism bit. Do we seriously see changes there, or is it still, well, it's very much, of course, depends on where you are. There are countries where people have a completely different view on what value creation means. And there are countries where, and businesses that just do not, let's call it, do not care beyond their shareholders and stakeholders. But I dare to say that, especially in Europe, and what we see, and what we've seen from Enel and Swiss Re, and we have many, many organizations, they take this serious. So if there are organizations, public interest organizations that are skeptical and cynical, we are dealing here in the field of ESG also for tax with a business trend, an unprecedented business transformation. It is about new value chains, supply chains transformation. It is about sustainable finance. It's on a huge global scale. And cynicism kills everything. So this is not something that is a hype. This is something that will be embedded within business operations on a grand scale and will not go away. So now, suddenly, tax comes on board. So, Bront, next slide, please. We've seen that one. The next one, please. Yes, this one. And this is basically, and I hate that word, the journey, but it's basically what it is when you look at tax. So we used to look at tax as a cost and compliance factor only. And suddenly we are in a field of climate and stakeholder centric, and we need to have a compelling story to tell. And preferably, we also need to embed somehow and help to support, let's call it, these sustainable development goals in 2030, or otherwise the climate we as a tax function, and how do we deal with that? And can we play a role in there? Well, I think, of course, we can play a role. And the letter E, everyone understands. But it's the other stuff that also takes you into account. And we also know what happens if you do not take good care of the letter S and the letter G as a business. P&O, payroll outsourcing, the discussion, the difference between workers and employees, between how some like to describe it, modern slavery and employees, labor law. So many platform organizations, they have independent contractors and not employees. Why? Because you don't need to withhold withholding taxes, social insurance premiums, sickness premiums, etc., 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 etc. So it's, from a business perspective, it's an attractive model because you pay less. However, some investors say, well, that may not be a sustainable business model because you will see people leaving your organization, you may see strikes, etc. So we will calculate the potential risk of your staff and the difference between workers and employees, or you can use a boardroom payment. We calculate it into the pricing of your organization. And that's, of course, what happened in the UK with the IPO of, was it Deliveroo? That immediately sank through the floor because large institutional investors refused to invest in it. So here you see typically that wage withholding taxes and employment arrangements are part of ESG, are part of the value creation process of your organization. However, having said that, and yesterday we had a session, perhaps you've seen it, with the European Commission, and in this case it was the Fisc Committee. An argument also used against tax transparency: tax is difficult, people do not understand it. Then I dare to say, explain it better. If you can't explain how it works, then you just need to explain it better. If you can report, for example, how you reduce your carbon footprint, for which you basically need nearly a PhD in physics to understand the whole concept, but companies can report on that. And you cannot tell me that tax is too difficult for people to understand. The other argument is indeed that you often hear is cost of compliance, which can very well be the case. Business secrets, which can very well be the case indeed. However, the arguments heard against are the same arguments we heard upon the introduction of international accounting standards in 2002, that we heard with the introduction of climate reporting, and that we hear currently also with tax reporting.
Why?
Sorry.
I spoke with 3 Dutch on the phone today.
So also beware of time and questions. So are we at the end of the road when it comes to reporting and ESG? No, we are not. So we will have the under the corporate sustainability reporting directive, we will have standards. They start with climate and then human capital. Will tax be included? Yesterday, Paul Tang, the chair of Fisc, he mentioned it, that perhaps it is strange that tax is not a part and does not fall within the framework of the CSRD. It may very well be. We have, of course, the public country by country reporting initiative that will be ratified later, and whatever format it will. And I hope, I sincerely hope, and I strongly advise them, use something that already exists. Whether you use a BEPS template, whether you use GRI, but use something that does exist. it will make life more easy. But okay, I guess I dare to say, as a prediction, that within the framework of CSRD, tax will be included. Yeah, included. Yes, also in the United States. Also in the United States. The second one. How will the large rating agencies, the Standard & Poor's, Moody's, Bloomberg, Sustainalytics, etc., how will they start rating tax reports and tax behavior in their pricing mechanism and in their rankings? I think we've just seen the beginning of a trend with rating agencies looking at tax in the context to ESG and societal commitments of companies. But then again, I completely agree, just paying tax will not make a better world. So now I'm open to questions. I can go on for hours on this, so please.
Thank you, Eelco, for this very interesting presentation, and also for putting things into perspective. And of course, you are perfectly right that my categorization of what is a standard setter and what is not a standard setter was not correct. Questions. I think we have two questions in the chat, and I start with the two questions there. If someone else has a question, please raise your hand. The first one: will environmental taxes not put the EU at an economic disadvantage? The carbon cross-border adjustment rule only increases the cost for US business, EU business, not for Chinese business selling their products outside the EU, and China is by far the biggest CO2 producer. Of course, this is a question far beyond tax reporting, but you are.
But it's a good question.
Okay, go for it.
No, it's of course it's a good question. The whole carbon CBAM and whatever you see. I mean, we have a very intricate, hopeless international corporate tax infrastructure, of course. But there are some enlightened souls, thank God, at the OECD and in Europe and also in the States that try to simplify that system. So you may think that we have learned not to overcomplicate tax systems. There is a Dutch saying, and I'll try to translate it: a donkey never hits the same stone twice, if that's a proper translation. But I'm afraid we're doing that right now again. When you look at carbon taxes and what I mentioned, more than 3,855 types of environmental taxes, it will be a big mess. So getting perhaps agreement upon these environmental taxes on how to deal that on a global scale are of the utmost importance for competitiveness, for level playing field, but also to save the bloody planet. What's happening in the United States with the fires or the floodings here in Belgium? I live in Brussels, by the way. I mean, it's tremendous. We need to do something, and we need to align initiatives in order to remedy and mitigate these risks. And you don't do that by developing all kinds of individual taxes on this field. I mean, this needs global alignment. Am I in favor for these type of taxes against pollution? Oh yes, absolutely. And that's why because it changes indeed behavior. If you have to pay 195 euros per ton on carbon and you don't change your business, the costs of not moving will be tremendous, But if it were only an initiative of Europe, and if we see CBAM and let's call it the quite difficult operational side of it, you may argue if that's the best way forward. And again, that's perhaps something for the University of St. Gallen, and there's a lot of public data. So with a bit research in artificial intelligence, there should be plenty information available. How much on environmental taxes do the top 500 companies pay? And I would not be surprised if that would outstrip the total amount of corporate tax paid.
Thank you. Second question from Thomas. financial reporting, we still have the IFRS and US GAAP world, and in addition, the local GAAP world, which we know best, of course, in tax matters. And we now see also a fight, for Pillar 2 on a harmonization. Can we really be that optimistic that we see a global single set of standards in non-financial reporting in the next few years?
Yes.
And I would add in tax matters especially.
That I don't know. No, in the relationship between the EFRAG and the IFRS Foundation is very cordial, like it is between GRI and the Value Creation Forum, which you know better as SESB. There's a lot of co-creation and understanding, and a lot of contact between them. I am very positive that we will be able to pull this one through. When it comes to tax, I guess it is the EU that will have to come up with the first step by choosing a proper framework for reporting under the public country-by-country reporting thing they may come up with. It may very well be that it will be, I think that it will be difficult for them not to use the template of 207. A way of 207 and combined with a BEPS type approach. So what will be the exact reporting basis? Will it be consolidated, a legal entity? Will intercompany transactions be included or not be included? But it will have the looks of a 207 type of framework.
Okay, thank you. Further questions? Any? Yes, hello, Hans Kriebnau is there as well. Good to see you. Please go ahead.
Hi, thank you, Peter. Eelco, I know you a bit, but you breathe optimism. And I would like to do that as well. But when we look at the big tech companies, and yeah, you already indicated bit the problem, but you're talking about stakeholder capitalism, and there's of course talk also in the US about, let's say, more taking stakeholders' interest into focus, to take them into account. But is there really changing something over there? That would be my question. They are, especially, let's say, Silicon Valley, these are almost very, very hardcore libertarians. So isn't that a huge problem to change just a little bit the world, so to say?
Yeah. It has to do with one's vision on where a state is for and what it should do and what your role is within society. And so the old Friedmanian principle of we are here only to make profit for our shareholders and the rest is the responsibility of the state is a bit weird in itself, because if you would use that for tax, and then tax minimization is the sole purpose of your tax department and tax organization, then where will the public funding be indeed to take care of the fire workers that extinguish the fires that rage in California, bridges that collapse, etc., etc., etc. So the shareholder capitalistic centric idea by itself doesn't work, because the environment you operate in will slowly diminish to something that will cost you dearly. That's the example we've seen in South Africa. Unfortunately, there are some people that are either out of a political reason think that a state should not be there and that it's pay as you go, or there are people that are plain stupid. And we will always have stupid people and people with different political beliefs. But I really think that there will be a transition also with these organizations. And would it not be only for altruistic reasons for doing good. I have a couple of clients that work in the oil and gas industry. And yeah, well, fossil fuels are not that good for climate, etc. And we all know that, and there's empirical evidence, etc., etc., etc. So what are some of these organizations doing? They are reinventing themselves. So what they now do is they use their old oil wells, not to pump up more oil, but to store carbon. So you get also by a push from pure economic reasons, for pure economic purposes, towards producing and working in a different manner. So it's not only altruistic and trying to do good, it also makes business sense. And that's what I meant when I said that ESG is no longer a hobby for leftish people smoking pot on the beach and shouting and drinking beer and shouting that the world must become a better place. It is really becoming mainstream business to take into consideration what the effects are for employees, the local communities you operate in. An example, one company that started to report under GRI 207, they were surprised by the positive responses they got from the working council and from the employees, because the employees suddenly had a story to tell on birthday parties and to their friends or in bars. Well, they were constantly being harassed in the press by tax dodgers and whatever. So they had a story to tell. And in fact, that organization had not thought firsthand that one of their most important stakeholders for the tax story were their own employees. So you see all kinds of, it's not just starting to report that the world will change. No, it is a tool in a subset of pressure points that drive businesses to change. And also, let's face it, in most boardrooms are very smart people that also are considerate for climate and their own children and grandchildren, etc., etc., etc. But that makes me optimistic, Hans. But you know me.
Let's say, yes, but that optimism I share with regard to, let's say, the ESG, but let's say especially this tax part, that's very much against the libertarian strain of thinking in Silicon Valley. And that is, of course, most at the moment, I would say.
Yeah, no, that's where, and that is a fact of life. There is not a silver bullet or one thing that cures all. So if people want to remedy it, look at legislation and enforcement, and make the system simple. Make the system simple. And but Hans, let's face it. What's currently happening with ideas on a global unitary tax, on a minimum rate, stuff happening like that. 5 years ago, we wouldn't have thought that was possible.
No, that's right. That's right.
Okay.
There's another question. Sorry. Yes.
Sorry to interrupt. I'm trying to take two last questions and then we close the session in order to be on time. So I have Elise, but first I start with Ilan's question, which is in the chat as well. I briefly read it out. So in Peter's, that's my session, we established that there is no link between tax payment and SDG achievement. In Eelco's session, though, we established that modern society links tax transparency reporting payment to sustainability. In my opinion, it is therefore rational for the investor community to ask for increased public tax transparency as a tool to assess M&E's earning quality as evidence of effective tax risk management, for the tax function of an M&E to invest a state-of-the-art tax transparency report tax policies. Question: who defines what modern society wants? Why did this change over the last years, decades? If I may add, I sometimes believe it's a chicken and egg problem. now, people believe we have to do this reporting in order, to be sustainable. But we don't know who was first, the reporting obligations or the public perception that this is a good thing, what we are doing. So by having said that, I hand it back to Eelco.
Yeah, Oh, it's a good question. It's a perfectly fair question. And again, GRI in its activistic heydays when it was founded in 1997 was founded upon request of investors. They wanted to see comparable data on these type of issues because there will undoubtedly have been an element in it for the public good, but it was also for risk assessing and creating comparable data on important stuff. Some more far-seeing say, okay, so if we don't take long-term effects of water pollution into account, then that will destroy value by itself. Who decides? Society decides, and that's also the issue with legislation. Okay? Society is, if we like it or not, in democratic environments, decide who will be the lawmakers during the next election. And who will be that is what at that moment in time has a majority from the voters on their ideas how a country should be run. And an integrated part of how a country should be run is a tax system. And the tax system has apparently in the past years been deemed as not too fair because some people pay nothing and some people pay a lot. And that's then what's setting the tone in a public debate and what modern society wants to see. Well, we can jump up and down and disagree on how a tax system should work. But one thing is sure, people want to see more transparency. People want to know more about tax behavior, especially investors. Can that change over time? Of course it can change over time. Everything changes over time. And that's, sometimes you hear that the laws and regulations cannot meet the pace of change in the world. Perhaps that's not that bad. Perhaps that gives us more time to reflect on current system and in making and introducing new systems. What I currently see happening, that is what I also call the extra legal tax environment, is that there happens a lot outside legislation that infringes taxpayers' rights, or things are being presented not as a tax but as an environmental levy, whereas they are just tax. Which can be pretty detrimental to the credibility of the whole system. I don't know if that answered the question. It's a very philosophical question.
Yeah, but it highlights a bit also my concerns, because you mentioned that if there is a democratic choice for transparency, fully understood, but then the reason for having legislation or reporting standards is to have more transparency because democracy wants it, and not in order to improve the SDGs.
Yeah.
And that's a bit the problem I have, that we need to have clarity about why we are doing something. But I hand it over to Inalise for the last question. I hope I pronounced your name correctly.
Yes, thank you. Sorry, I couldn't resist asking a question to one of my old colleagues and favorite, probably tax advisor. Hi, Eelco. We spoke about the ESGs, or you spoke about the ESGs a lot, and specifically with relation to the external stakeholders. And when I also speak to my clients, I advise large corporates in South Africa on similar matters. We do, that's usually where the conversation starts. But with you being involved in the GRI, and I assume also having rolled out a lot of that for your clients, the benefit of that whole exercise of going through the transparency reporting, following a standard like the GRI. I asked a similar question for Enel as well. How does that benefit your clients internally as well? They've made the link between tax and sustainability, tax and ESG. they've gone through the motion of actually writing their tax story. But for me, always the selling point is how will it benefit them internally as well, not just externally. And what has your experience been?
I will try to explain, and I also refer to Alan McLean's yesterday's introduction remarks for the FISC committee. You can find that on the link of the website of FISC, where he described the process Shell went through to start to publish their transparency reports. Staff personnel benefited. It increased also the image of the organization itself in society, which put off a lot of strain and, let's call it, defensive time spent. It created, in fact, for them more value. Because they could focus on those things that, instead of trying not to say what was happening, basically.
Thank you.
And it is, of course, it is, as Jessica Uhl, their CFO, says in the introduction to last year's report, tax transparency, it's not about data, it's about the narrative around it. It's about the story within it. Not paying tax can have perfectly sound and solid reasons. We had just a question on what society thinks. A couple of years ago, Dutch society thought it was a brilliant idea to deduct liquidation losses of subsidiaries abroad, whereas the dividends received are tax exempt. And suddenly everyone says that's ridiculous and that should not be true, and it's a scandal that they do not pay tax because they liquidate their foreign, etc., etc. But that was just the execution upon the law.
Okay, thank you. So then I use my chance to first of all thank Eelco for his very interesting presentation and the questions that he has received. But then I would also like to take the chance at the end of the conference to thank the organization, Ladislava, Josiane, Frederic, Manuela, all who helped to organize such cross-border conference or international conference, unfortunately online, only in an online mode. And then, of course, thanks to all the speakers again. I think it has been 2 very interesting days. And thanks also to the co-organizer, Irma, Florian, and Thomas. I think we want to build up a forum also for discussion, also for critical thinking, as you have realized on reporting obligations. I think that's also one of our tasks as an academic institution, also to challenge existing regulation and try to figure out what is good and bad for society. And by having said that, I think it's time not yet to enjoy the weekend, but soon. So many thanks that you all have participated, and see you again somewhere in the world, hopefully. And it was a pleasure.
Thank you.